Since about a year or 18 months ago, companies, investors, and politicians have been very worried about inflation and have talked a lot about it. In this video, we'll go over a hierarchy of different types of investments and how they rank when inflation is high. All of this is what Warren Buffett says. He is 91 years old and has lived through inflation, so he knows a thing or two about it. When I was doing research for this video, I watched hours of interviews with Warren Buffett. All I ask is that you click the like button. Really, that's all fine, and if you aren't already, you should subscribe to the channel. Let's watch the video now. Cash is the worst thing to invest in when prices are going up. Even Warren Buffett doesn't like holding cash when prices are going up. Ray Dalio, another billionaire, has also said that cash is trash, which is a memorable and kind of catchy phrase. During times of inflation, money in your savings account, your dress, or your empty home loses value every day, week, month, and year. One of the most important things I want you to learn from this video is that, as an investor, you need to think about your investment returns in what are called real terms. It's easy to figure out what your real return on investment is. Let's say that your investments gave you a 10% return every year. That's awesome. Right? Not so quickly. It really depends on how fast prices are going up. To figure out what your real return on investments is, you need to take inflation out of the picture. So, if inflation is 7% that year, your investments will earn 10%. Only 3% is what you really get back. Not even close to as fun. Right? Because of this, cash comes last in this list. Because the return on cash is almost zero, keeping cash for a long time lets inflation hurt you. Above cash on the hierarchy of investments are fixed interest rate bonds. The standard advice for investing says that these investments are usually very safe. But Buffett would say that when inflation is taken into account, these investments aren't really all that safe. I'll tell you what I mean. The return on a 10-year US government bond is about 1.8% right now. As of the time this video was made. This means that if you bought a 10-year government bond today, you would get a return of 1.8% each year for the next 10 years. Let's say that inflation averages 4% over the next 10 years. This isn't too far-fetched, given that the most recent report on inflation put it at 7%, which would make 4% inflation the norm. After taking into account the effect of inflation on your return, this means that your real return would be minus 2.2% per year. Now, this is still better than just holding cash, but it is still a long way from being the best. You know, if we put $1 million in each home in the United States right now, everyone would feel great, except for those who had invested in things that were priced in dollars. And it's important to keep in mind that people who have fixed-rate debt like government bonds lose when inflation happens. On the other hand, people who borrow money for a long time at a fixed rate win when inflation is high. People who use a mortgage to buy a house in December 2020 is an example of this. When I bought my house, I was able to lock in a 30-year fixed-rate mortgage at 2.8%. This means that the rate of interest won't change for the next 30 years. Also, my mortgage payment will stay the same for 30 years. When prices are going up, this is a great place to be. This is because inflation eats away at the value of the mortgage debt month after month and year after year. Since inflation makes each dollar worth less and less, I get to pay off my mortgage debt with the value dollars. But if you own a home with a big mortgage and there is a lot of inflation, the mortgage goes away and you still own the home. I mean that in the end, in Weimar, Germany, you got your mortgage back. That was a lot of fun to hear. That's the next thing on the list, and it's what Buffett calls his unproductive assets. Gold, silver, and other precious metals are examples. Now, these aren't terrible to have during a time of inflation, because the prices of everything else are also going up. At the very least, these things should keep up with inflation. But these assets that don't make you money probably won't help you buy more things either. Let's hear what Warren Buffett has to say about this. This is what I will say about gold. If you took all the gold in the world and put it in a cube, it would be about 67 feet on each side. So, if you took all the gold in the world, we could make a cube that was 67 feet down and 67 feet high. That would be the end of it. At today's market price, that same cube of gold would be worth about $7 trillion. That is probably about a third of the value of all the stocks in the United States. So for $7 trillion, you can buy a third of all the stocks in the United States, or you can buy that little block of gold that can't do anything but shine there and make you feel like minus increases or something like that. About 1 billion acres of farmland can be found in the United States. About $2.5 trillion is how much they are worth. About half of the land in the continental United States is used for farming. You could have all the farmland in the United States, about 7 ExxonMobils, and $1 trillion in cash on hand. But if you gave me the choice between looking at a 67-foot cube of gold all day, touching and fondling it sometimes, and then telling it to do something for me and it saying, "I don't do anything, I just stand here and look pretty," I would choose the gold cube. You might think I'm crazy, but I'll take the farmland from the ExxonMobils. Let's move on to the next category of investments in our inflation hierarchy. These investors don't just want to keep up with inflation, they also want their investments to do better than inflation and give them a real return. Here comes into play what Warren Buffett calls his productive assets. Now, everyone knows that Warren Buffett made a lot of money by buying stocks and whole companies. But Buffett says that not all businesses are the same. After inflation, productive assets are the next most important thing. Average businesses have a few things in common, and one of them is that they need a lot of extra capital, which is just a fancy word for cash, to keep running. Most businesses will not do well in real terms during inflation. Their earnings may go up over time, but they have to put more and more money into the business just to stay in the same place. And you should know that the worst kind of business is one that always makes you put more money on the table without giving you more money back. So, here's a simplified example using a real company that should help you understand what I mean. United Leasing. Ticker symbol U. RE is the biggest equipment rental company in the world. Their business plan is pretty simple. United Rentals buys things that are usually used in building projects. So things like bulldozers, portable toilets, and heavy-duty trucks. Then, United Rentals gives that equipment to construction projects for a short time, usually the length of the project. Customers can rent this equipment from United Rentals, but it's clear that it won't last forever and will need to be replaced every few years or so. Let's say, to keep things simple, each bulldozer the company buys costs $1 million, and let's say that over the lifetime of that bulldozer, it can be rented out to customers and bring in $1.2 million in sales for the company. That's a nice return of $200,000. But for this example, let's say that inflation is 20%. This means that when the company needs to buy a new bulldozer to replace the one it already has, it will have to spend $1.2 million. Look at what's going on. The business can't give the company any money in the form of profits. All of the money that United Rentals makes in profits has to go right back into the business to buy new equipment to replace the old equipment. Now, I don't think that inflation will be anywhere close to 20%. And United is a great business. But this shows how hard it is for businesses that need a lot of money to operate when inflation is high. Before we talk about the next trait of businesses that you should avoid during inflation, let's tell a quick story. This quote came from Charlie Munger, who works with and is friends with Warren Buffett. That pretty much says everything I said. There are two types of businesses that do well. One is a business where all of the profit reported just sits there and you can take it out of the business at the end of the year. And the business will be just as successful without the money as it would have been with it. The second business makes money, but there's never any cash on hand. It reminds me of an old friend who used to sell used construction equipment. He used to say, "In my business, you make money every year, and here it is sitting in the yard." There are a lot of businesses like that, where you just have to keep going to stay in the same place. There is never enough money. The next trade you want to stay away from is with businesses that don't have what's called pricing power. The best way to explain what I mean by companies that don't have pricing power is to talk about a company that does. When I think of the power to set prices, the first company, which I think is Apple, has customers who are so loyal that many of them will pay whatever price Apple wants for its iPhone product. If someone wants a new iPhone, they won't buy a product from a different company. Let's say a company makes plain white t-shirts. Let's compare this to a situation where the company has little or no pricing power and the only thing the customer cares about is price. The company only makes plain white t-shirts with no designs or logos. This company doesn't have pricing power because people will just buy the cheapest white t-shirt they can find. This t-shirt maker also can't raise prices higher than its competitors because its prices are already higher than those of its competitors. People will just buy the white t-shirts of this company's rivals instead. This company will have a hard time in a world where prices are going up. The cost of the materials used to make the shirts, the cost of paying the people who make the shirts, and the cost of shipping the shirts to customers are all going up. The price the company can charge for its shirts is the only thing that isn't really going up. Now you see why inflation is so hard on companies that don't have the power to set prices. Let's move on to the next type of investment on the list. Let's call these investments assets that make money and great businesses. I know that name is very clever. Here's an additional example. Remember how the business in the first example spent $1 million on a bulldozer. Now, let's say that our friend John uses that same $1 million to make a piece of software that makes it easier for people to make videos on YouTube. Like in the first example, let's say that John sells this product and makes $1.2 million in the first year, which is a $200,000 profit. Great. But wait, it gets even better. In this example, let's say that there is also 20% inflation. This means that John can charge 20% more for his software this year than he did last year. This means that John's sales last year of $1.2 million are now worth $1.44 million after inflation of 20%. But the good thing about John's software business is that he doesn't have to put any more money into it. He already has the software, and he may have to spend a small amount of money to keep it up to date and in good shape. This is the opposite of a business that needs a lot of money to run. In the first example, John's software business would be called a capital-light business because John won't have to keep putting much money back into the business just to keep it running and making products. This means that John can take his profits out of the business and not have to keep putting them back into the business to keep it running. To find a business that does well when prices go up, like the equipment rental company in the first example, you need to look for one that does well in general. You want to find the opposite of the average business we talked about earlier. You want to find a business that doesn't need a lot of money to start up. Most of the time, these are businesses that don't need to keep putting large amounts of money back into the business in order to grow. These are companies with very well-known brands, like Apple, Coca-Cola, and Buffet's own See's Candies. Other kinds of businesses that don't need a lot of money to start are ones that don't need a lot of physical assets, like factories or a lot of inventory. So, think of companies like Microsoft, Facebook, and others that focus on technology. Almost any software company falls into this category, because once the software is built and the money is spent on it, the company is done. Compared to most businesses, the amount put back into the business is not very high. Pricing power is another important part of a company you want to own when prices are going up. I'll be the first to say that figuring out how much a company can charge is more of an art than a science. But here are some things to think about that might help. Think about how a customer would react if the company raised its prices by 10%. I think this is a good exercise. Customers could react in a variety of ways, ranging from not caring about the price increase to being very upset about it. During times of inflation, I'm not going to pay that much for my money. When prices are going up, you should buy stock in companies that can easily raise their prices. Want to avoid investing in companies and industries that have a hard time raising prices even when things are going well. I want to end this video with some important advice from Warren Buffett and the best investment of all time. I mean, if you're the best brain surgeon in town or the best lawyer in town or whatever, you don't have to keep retraining yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, so you don't have to keep reinvesting, and you keep your earning power in current dollars. Investing in yourself is the best way to protect yourself from inflation. If you're the best at what you do, whether you're the best mechanic, lawyer, dentist, plumber, or accountant, you make yourself very valuable to other people. When you are very valuable in the marketplace economy, you can pretty much charge whatever you want for your services, and people will be happy to pay it. So, there it is. As always, I hope you liked the video.